Brian, as we know, the Fed decided to keep interest rates in range 5.5 until 5.25 until 5.5%. What is your opinion on this? Is this in line in the market predictions?
I think it was broadly in line with what the market was expecting just before the meeting. And I think the way to see it is that in the 18 months up to up to the summer, the Fed was raising rates every single meeting, and they were desperately trying to get rates to what they thought was a sort of suitably restrictive level. I think that the pause that we've had at the last two meetings is a reflection of the fact that they think they're quite close now to getting rates to a level that they think is high enough, quite close.
So, do you see that how far as a possible will the Fed raise interest rates against in the end of 2023, at the end on the 2023?
Yeah, I think there is one more rate hike coming from the Fed in December. If you listen to what Powell said, he was very aware of the fact that the consumer spending accelerated again in the third quarter, and the labour market is not loosening in the way the Fed thought it would be. And that raises risk that core inflation pressures just don't come down quickly enough. It was actually quite hawkish in his comments when I read them in detail. So I think they will follow through with one more rate hike. They're slowing down the pace of increases. We've got these pauses now, but I still think there's one more hike left from the Fed in December.
In these conditions and position, will the Fed remain aggressive in raising Americans' inflation target to 2% in 2024? Is there possibility that the Fed will lower interest rates maybe in 2024, or still strict on the target inflation in 2%?
Yeah, I think they're not going to be in any rush to start cutting rates. So given that the economy is now, it's looking less likely that we're going to see an outright recession in the first half of next year now. So the consumer's strong and the labour market is resilient. I think against that backdrop and the risks that keeps inflation high, probably not till next summer that they start to cut rates. I think they will feel confident by then, but I think it's going to take several months before they're comfortable enough. One more hike to come, and then probably a six month pause at the plateau.
Okay. Do you see that the Fed still strict on the inflations and the target inflation in 2% in United States, right?
Yeah, I don't see any intention to change that at all. In fact, if you listen to Powell yesterday, he was very much, it's the most important thing for the Fed is to get inflation back down again. That's what's causing hardship. That's their primary goal. And with growth strong, that they feel that they've got the mandate to really make sure inflation does come all the way back down to 2%. And they still feel that they're quite a long way from achieving that. I don't see any willingness to sort of loosen their commitment to 2% at all.
Okay, moving on to the U.S. strength economics. Fitch Ratings estimate that headwinds will slow U.S. consumer spending significantly in the first half of 2024. The labor market will weaken, wage growth will slow, and public consumption will slow. Then borrowing costs have also soared. Long-term bond yields are the highest level in years. So is the Fed perhaps too optimistic about the strengths of the U.S. economic data?
Well, we do think all these factors are going to be a significant headwind, and we definitely see a sharp slowdown in growth next year. And the rise in bond yields in the last couple of months is certainly a new development that could add a little bit to those headwinds. But at this point, I think the broad conclusion is that the economy has been more resilient to rate hikes than the Fed and most people have expected. So I can sort of understand why the Fed is quite optimistic on the growth outlook. We think they're a little bit too optimistic. But to be honest, that they've got that call right in the last couple of months. The resilience that we're seeing in the consumption and the labour market side, it's taking a long time for interest rates to feed through to household interest service. So many mortgages in the US are sort of fixed for 30 years. And so you get a very slow feed through to higher debt interest payments from households. We are seeing that on the consumer debt side, but not really on the mortgage debt side. And so that transmission lag, if you like, but from monetary policy tightening to the economy is taking longer. And I think that's a concern for the Fed. They're now starting to worry a bit more. Have they done it? Have they done enough? Is the economy too strong? It's going to continue to put upward pressure on inflation.
Okay, so Fed Chairman Jerome Powell highlighted that elevated geopolitical tensions following the conflict in the Middle East. So how significant is this the factors that could change the Fed policy?
Yeah, I mean, we got to have to remember is that part of the reason inflation's been coming down in the United States and in Europe and elsewhere is that the oil price has sort of stabilized on a year-on-year basis. Energy prices are falling, and that's been an important part of bringing down overall inflation. But of course, that part is sort of out of the control of the Fed. So the fact that we've now got this new upside risk to oil prices coming from the tensions in the Middle East, I think is making central banks, including the Fed, a bit nervous because, if the oil price goes to $100, $120, that's going to put upward pressure on inflation. And a lot of the good work that people think, is maybe down to the Fed, but is really just down to the oil price, that could be very rapidly undone. So I think this is definitely something that makes them even more cautious, making sure that they don't start cutting rates too quickly, they don't peak rates at too low a level.
Okay.